Hello everyone, I'm Pearl Thakkar and today I'm presenting key insights from Parag Parikh Sir Book Value Investing in Behavioral Finance, along with Group 18 whose members are Vansh Gangnani, Asim Mansoori, Kanish Gupta, Nikun Singhania, Rhea Shah and Vidhi Jain. This book is a classic because it doesn't just talk about numbers and markets, but it explains the psychology behind investing and success. Beginning with the first chapter, Success and Failure, he starts by reminding us that success and failure are both predictable. The difference lies in character and discipline. People often fail because they cannot delay gratification. Economists call this the biggest reason for economic failure. Success, on the other hand, requires resisting the temptation of short term comfort and focusing on long term goals. He explains this through the expediency factor or E factor. Most people choose the fastest, easiest way to get what they want, even if it means pain later. True success comes to those who resist this pull. Human nature itself drives our choices. Traits like laziness, greed, ambition, self interest, ignorance, and vanity. This can motivate progress, but also leads to shortcuts and underperformance. The lesson is clear: success is equals to self discipline, persistence, and focus. Failure is equals to trading future gains for present comfort. He also uses the law of farm to illustrate that there are no shortcuts. Just as seed takes time to grow into trees, success requires patience and effort. And lastly, he also stresses on the competence balance, a proper mix of IQ and EQ. Both are mandatory for successful life and for successful investing. Next slide, please. Moving to the second chapter, Understanding Behavioral Trends, he shifts focus to investing. He explains that markets are not risky because of poor business performance, but because of human behavior. The core dilemma is this: higher returns tempt investors into higher risk. Equities look risky due to price swing, but fixed income is actually riskier because inflation erodes purchasing power. So total returns are a mix of two forces: fundamentals, earnings and dividends, investor sentiment, emotions like fear and greed. Next slide. He illustrates this with a hypothetical study. Even if earnings grow steadily, changes in the price to earning ratio driven by sentiment can make returns widely positive or negative. This shows why investing feels risky. It's not the fundamentals but crowd behavior that creates volatility. He concludes that successful investing is difficult because most investors act emotionally, following the herd. The way to succeed is to go against the crowd, be emotionally strong, take informed decisions, and balance analysis with discipline. With this foundation of first two chapters, we can see how psychology shapes both personal growth and financial decision. Let's move forward. I would like to hand over it to Vansh. Thank you.
So, hello everyone, my name is Vansh Kagnani and I will be continuing this presentation. So, let's begin. Let me start with a simple question. Why do investors make mistakes even when they have all the information? Now, this is where behavioral finance comes in. Behavioral finance is basically the study of how emotional and psychological biases influence our financial decisions. And the first slide here shows how our mind misguides our money and how our behavior plays an important role in investing. For example, we often sell winners too early in order to lock the profits. We buy expensive stocks due to FOMO, that is fear of missing out. We hold on to the losing stocks for too long, hoping that they will recover. And very commonly, we often follow the crowd because we assume that the crowd is always correct. Now, moving on to the next slide. Now, this slide basically explains the true value of an asset and the two investing styles. So, here we have value in use and value in exchange. Value in use basically refers to those commodities which are essential but lower priced, like water, whereas value in exchange refers to those commodities which are non essential but higher priced, like precious metals like gold. Now, the two styles of investing are value investing and growth investing. Value investing basically focuses on buying stocks where the price is less than the intrinsic value. It is based on fundamentals, patience, and margin of safety. Whereas growth investing focuses on companies with higher future potential. These are called dream stocks because investors expect rapid growth even if the current market price is high. Now, moving on to the next slide. Now, here we have some common psychological biases which make contrarian or value investing difficult. First, recency bias. We give too much importance to the recent events and assume that these trends will continue. Second, loss aversion. Losses hurt us much more than the gains feel good, so we avoid selling at a loss. Third, herd behavior. We blindly follow what everyone else is doing, and this is known as the herding effect. Fourth, instant gratification. We desire to make quick profits, thinking without thinking of long term. And then we have confirmation bias. We only look for the information that supports our existing beliefs. And finally, we have availability bias. We rely too much on the readily available information and then make judgments. Now, thus, these biases don't just destroy markets, they destroy investors. Now, coming on to the fourth slide, this is where everything connects. When the crowd is buying aggressively, the prices go up and often beyond their true value. And when the crowd starts selling, prices fall, sometimes below their actual worth. Now, this creates a cycle driven by emotion and not logic. A conventional investor follows this crowd, but on the other hand, a contrarian investor does the opposite. He buys when the crowd is selling and he sells when the crowd is buying. Now, finally, looking at the risk versus reward scale, we understand that when the prices are high, the risk is high and the margin of safety is low. Whereas when the prices are low, the risk is lower and the potential reward is much higher. So, smart investing is not about following the crowd, it's about identifying when the crowd is making a mistake. So, to conclude, successful investing is not just about knowledge, it's about controlling your behavior because, in the end, the biggest risk in the market is our own mind. Now, I will be handing over this presentation to Asim to take you through the next topic.
Hey guys, this is Asif. So, uh, I want to go through a quote said by Warren Buffett that be fearful when everyone is greedy and be greedy when everyone is fearful. So, what is growth trap? Growth trap is something when investors or a crowd follow a particular sector, a particular stock, or particular company by saying or expecting a very pessimistic, a very optimistic for that particular stock, industry, or sector, and they invest heavily in that particular stock, a sector or industry, and this create a growth trap. They only look into the expectations out of the blue, and they are sailed by the biasness of information like herd mentality, availability heuristic, and overconfidence bias that they will outperform the value investing. But to escape a growth trap, we have value investing. That is, when we have to escape the growth trap. Growth trap is something when the investors invest more and more by seeing the expectation rather than seeing the fundamentals. In escaping the growth trap, we have to see the quality of management, sustainable growth, their strong cash flow, the reasonable returns like dividend and capital appreciation, and we have to buy at right valuation. If we buy a stock or any commodity or anything with an expensive price, the returns are tend to suffer, which makes the investment a losing investment. So when it comes to investing, we should buy when everyone is selling, and we should sell when everyone is buying, like the quote I have earlier said. So, to escape the growth trap, we have to avoid the novelty trap. Whenever a novelty company or a unique company comes into the market, people start following that and investing heavily in that sector or company or that company. So, we have to avoid the herd behavior or herd mentality by which we can escape the growth trap. And we have to look beyond PE. And because not every high PE stock is worth paying a high price. So we have to look beyond P. Now, I would like to move on commodity stocks. Commodity stocks are such stocks which are subject to the prices of commodity. If the price of a commodity rise, the stock price also rise. If the price of a commodity falls, the stock price also falls. Here in commodity stocks, the value parameter fails, and no value parameter works here because of the cyclical nature of the commodity. So when it comes to commodity investing, we have to we have to follow the same thing. Like we have to resist our herd mentality and start chasing against the crowd. So in commodity investing, people always choose market leaders over market laggards that are high cost producers. But high cost producers outperform market leaders in the boom run of a commodity because they have low biasness, they have tax carry forward due to previous losses, and the margin jump is so high that they can outperform the market leaders. So, I would like to handle over to Kanishk for the PPT.
Thank you, Asim, for a wonderful presentation. Hello, everyone. I am Kanish Gupta, a student of Finacle Institute. This slide talks about the psychology of mispricing. Now, what do you understand by mispricing? Mispricing of a stock means that the stock is either overvalued or undervalued. In PSUs, we observed that their maximum stake is owned by the government. Hence, they were slightly inefficient due to the bureaucratic and political control and less competitions. This led to strong negative biasness and crowd pessimism. But retail investors ignored the assets these companies had, such as oil refineries, oil distribution networks, large manufacturing units, defense infrastructure, etc. Similarly, in sector-wise stocks, there was over-optimism with respect to selective sectors due to Hart's behavior and greed-driven overvaluation. Retail investors started assuming that sector growth is equal to guaranteed stock returns and were attracted by recent performance. However, they ignored that entry price has already discounted the bullishness of the sector and economic conditions. As a result, they end up buying an overvalued stock. Therefore, we should follow contrarian investing, as explained by my colleagues, and value stocks on the basis of their earning potential and valuations. Change the slide. This slide highlights factors that retail investors tend to ignore, like strong assets backing, which acted as an important moat for PSUs. Economic policies such as LPG reforms that boosted PSUs' performances. In sector investing, we should ensure that we are not becoming part of the bubble trap, that is, entering when stocks are already overvalued. Stocks should be judged based on earning potential and future growth expectation. Hence, always follow a top-down approach. That is, analyze economic conditions, study government policies, select sectors based on earnings visibility, then choose stocks considering the company's fundamentals, long-term performances, and the cyclicality of the sector. Next slide, please. This slide talks about what is to be ignored, like perception of people, herd mentality, media trends, and the bubble trap. That is, perception is not reality. Hence, always invest after deciding the valuation and entry timing beforehand. To conclude, I would, if you want to earn huge returns from the stock market, it takes 15 years. But if you want to create wealth faster, then it takes 25 years. This is the irony. Hence, value investing is better than growth investing. Thank you. Now, I would like to hand it over to Nikunj.
Hello everyone, my name is Nikun Singhania and today we dive into the psychology and mechanics of the stock market. Starting with the IPO phenomena, we often see IPO as golden opportunity for listing gains, but the reality is more complex. Companies typically issue IPO for three reasons. First, to reduce debt. Second, to fund massive expansion. And third, more often for promoters to dilute their stakes when market sentiment is at its peak. This leads to the timing trap. You will notice IPO don't mushroom in bear markets. They are flooded during bull run when the greed is high and valuation far exceeds fair value. This creates winner curse. Driven by FOMO and allure of the new, retail investors often miss out on initial allotment only to buy the stocks on the listing day at a massive premium. History from the 1990s dot-com bubble to the recent real estate crisis shows euphoria eventually fades. Even statistics reveal that over 50% of the new issue deliver negative long-term returns. The lesson here. The IPOs are more often about the seller's exit, not the buyer's entry. Moving on to the next slide, we address a new modern favorite, the indexing trap. Passive indexing is often marketed as an easy strategy, a safe spot for those who find picking stocks too hard. Big investment firm pushes this idea so much that we experience availability bias, thinking indexing is the only standard. They use low fees as psychological bait to make us think that saving little on cost is the ultimate goal. However, indexing has a major flaw. It forces you to buy what is already expensive and popular. As indexes are market cap weighted, they buy more of a stock simply because its price rose. This creates a price expectation gap. Since successful investing is about paying less than a company's expected value, indexing does the opposite by paying at its highest expectations. Next slide. Here we see lessons for investors. Passive indexing is often authority without responsibility. As index simply represents the market, the manager is not accountable if it performs poorly. They charge fees regardless of its performance, hiding behind the benchmark. Parag Parikh sir describes passive indexing as an idea whose time has gone. It exploits our behavioral bias through loss aversion, making us feel safe because we are with the crowd. But as value investor, we should choose value over popularity. Chasing fancy indexes is buying what everyone else is buying at high price. True success is contrarian. The ability to buy what others are selling at bargain and the courage to sell what others are buying at a premium. Don't get lured by low fees as at a cost of long-term wealth creation. Focus on quality and fundamental strength rather than quantity. Thank you. I would like to hand over this PPT to Riya Shah for further explanation.
Hi, I'm Rhea. Today I'll be introducing market bubble. Markets often go through bubbles where price rise too fast. Investors get carried away because of psychological bias. Availability heuristic. We buy into stories or hype seen in the media. Representative thinking. We believe if one stock or sector doesn't go well, all shall. Overconfidence and greed. Investors think we are smarter and chase quick profits. Now, moving on to the next slide. Red flags and warnings. IPO frenzies. Many new unknown companies entering the market. Value disconnect. Very expensive stocks not supported by fundamentals. Stories like Land Bank or Powering India justify high valuation, but often they are misleading. Round trip fancy. Cheap stocks have low PE. Hence, all stocks with low PE are assumed to be cheap. Now, moving on to the next slide. Historical example. Reliance Power IPO. In 2018, Reliance Power's IPO was called the mother of all issues and explains that investors were relying on Reliance brand, ignoring the actual value. This is an example of the availability bias. Real estate. Oriti City Mahindra, their PE ratios soared about 90 and 160, driven by faith in land banks, leading to growth trap. Tech bubble. Companies added .com and software just to inflate their price, a sign of irrational enthusiasm. To conclude, be careful. Recognize these signs early. Don't be fooled by hypes. Market can collapse when everyone believes price will keep rising. Now, my friend Vidhi Jain will continue.
Hi everyone, my name is Vidhi Jain and today I'll be explaining investor behavior through behavioral finance, focusing on how markets actually work versus how we assume they work. On the left side, we have the efficient market illusion. Traditionally, we believe in something called the efficient market hypothesis. It assumes that corporate managers make rational decisions and investors analyze companies based on fundamentals. So ideally, stock prices should reflect true value like a simple equation that is 1 plus 1 equals to 2. But in reality, markets don't work this cleanly. On the right side, we have the behavioral reality. In real world, markets have emotions like fear, greed, and herd mentality, which dominates their decisions. Investors don't just analyze, they react. This creates unpredictable outcomes like 1 plus 1 plus emotion, which is equal to anything 2, 8, 50, or even a 0. So, the biggest question becomes investors research companies, but do they research themselves? Moving on to the next slide. To understand market behavior better, we need to understand who is actually trading in the market. This is called profiling the free float. This matrix divides investor based on two factors: their level of analysis on the vertical axis and their trading speed or horizon on the horizontal axis. At the top, we have organization mavens, highly analytical, long-term thinkers like institutions. Then comes strategy junkies, focused on business models and innovation. Next are financial addicts. They react to news, earnings, and short-term events. On one side, we have loyal capital. These are long-term investors who act as a stabilizing force in the market. On the other side, we have mercenary capital. These are short-term traders who create volatility and price chaos. So, stock price don't just move because of company's performance, they move because of who's trading and how they behave. Moving on to the next slide. Now, let's apply this behavioral understanding to a real scenario. Stage one is trigger. When a company undergoes restructuring like Sun Corporation here, it initially creates uncertainty. Short-term profits may fall even if long-term growth improves. Stage two is the investor chaos. This is where behavioral finance kicks in. Different investors react differently. Some understand the strategy and hold, which are around 45%, and others panic and sell, which are around 35%. This creates chaos in stock price, not because of fundamentals, but because of emotions. Stage 3 is the new arena. Eventually, reality stabilizes the market. The price drop initially due to panic, then long-term investors step in and the stock recovers based on actual value. So the key takeaway is stock volatility is not random. It is predictable because it is driven by human behavior and not just numbers. So, to conclude the overall presentation, I would like to say Value Investing and Behavioral Finance by Sir Parag Parikh shows us that successful investing is a blend of logic and psychology. While financial analysis helps us identify good opportunities, our behavior and emotion often determine our final decisions. The book highlights common biases like overconfidence, herd mentality, and short term thinking that can harm investors. It teaches us the importance of patience, discipline, and long term perspective. By staying rational and not just getting influenced by market noise, we can make better and consistent investment decisions. Thank you.